One of the biggest headlines right now is the labor market. And the labor market can be a little bit difficult and maybe even complex to understand. So we wanted to highlight three separate things that you should really be paying attention to when you do see those headlines. Number one is that the job openings are slowing. Right now, if you look at the ratio, the number of openings per unemployed person is roughly 2 to 1, meaning there are 2 job openings per 1 unemployed person. That's not sustainable, and it's actually much higher than it was previous to COVID. We've seen that number start to trickle down a little bit, but we want it to go even further. So how can that happen? Well, there are 2 ways. You can either have the number of job openings go down, or you can have the number of unemployed people go up. The best option for our economy is to actually have the number of unemployed people go up. No, that's not crazy. Just think about it for a second. Unfortunately, right now there are a lot of people in the economy that aren't actively pursuing a job. Once they decide to get up and start to look for employment, that number will start to trickle down closer to 1, which is what we want. Number 2 is that businesses are cutting costs. And it's not because of a negative outlook or a downturn in demand. It's actually just because they're looking to be more efficient and to increase their productivity, which is a great sign, right? At the end of the day, if they can do that with less people, that is a good sign for their bottom line. Number 3 is that the labor market is strong. We know that certain aspects of the economy are struggling. Real estate is slowing. The global economy is slowing. And the labor market seems strong enough to offset some other areas of the economy that may be weak. And it seems that it can withstand the Fed rate hike cycle that it's currently in. Looking ahead, the real question really kind of lies on what is the lag between the action taken by the Fed and its impact on the economy. We should know there is some sort of a lagged effect. And it's possible that the rate hikes from previous meetings haven't even really been felt yet by the economy, just because it takes some time to ripple through. That's the whole point of the front loading that we've been experiencing. But how much time will it take this time around? Well, one could argue that the transmission is faster now than it has been in previous market cycles or in previous decades. If that's the case, there's a real probability that we won't see another 75 basis point hike, but rather maybe just 50 basis point hikes. That would be a great sign, obviously. Right now, all eyes are on inflation, and if you've been looking, that recent CPI report that was released was a pretty good sign. Thank you.